The world is ending. At least, that's what the red scrolling tickers on the news want you to believe. Panic has a specific sound. It's the frantic clicking of sell buttons at 2 a.m. It's the collective exhale of billions of dollars evaporating into the digital ether. Most people see a market crash as a funeral for their future. They're wrong. A crash isn't the end of the game. It's the only time the board gets tilted in your favor. If you want to understand how millionaires are actually minted, stop looking at the green candles. Start looking at the blood. Right now, the global economy is a stretched rubber band. Interest rates, debt cycles, and speculative bubbles are pulling in opposite directions. Everyone is waiting for the snap. But while the majority prepares for a disaster, a small, quiet group is preparing for a sale. To understand why, we have to look at the plumbing of the system. Imagine an apartment building. In a normal market, that building costs $10 million. It generates steady rent, but the entry price is too high for you to ever own it. The math doesn't work. Then the event happens. A liquidity crisis. A bank failure. Suddenly, the owner is desperate. They don't need $10 million, they need cash, and they need it by Friday. The price drops to $5 million. The building hasn't changed. The bricks are the same. The tenants are still paying rent. Only the perception of its value has shifted. This is the hidden mechanism of a crash, the decoupling of price from reality. In a bull market, you pay for hope. In a crash, you pay for math. Here is the uncomfortable truth. Wealth is not created during the recovery. It is merely realized then. The wealth was actually created at the moment of maximum pain, when you exchanged devaluing currency for undervalued assets. The math of a 50% drop is seductive. If an asset drops by 50%, it doesn't just need to go back up by 50% for you to break even. It needs to gain 100% to return to its previous high. If you buy at that bottom, you aren't just investing, you are capturing a mathematical spring load that the average person is too terrified to touch. But there is a catch. The system is designed to shake you off. The media will tell you this time is different. Your lizard brain will tell you to preserve what's left. The irony is that the safest time to buy feels like the most dangerous, and the most dangerous time to buy, the peak of the hype, feels the safest. The crowd buys when the sun is out. The wealthy buy when it's pouring, because they know the sun is an inevitability of the cycle. But don't mistake this for a guarantee. A crash is a filter. It filters out the over-leveraged, the emotional, and the impatient. If you buy a dying company just because the price is low, you aren't a visionary, you're a gambler catching a falling knife. The real secret isn't just having the courage to buy, it's having the discipline to wait for the specific moment when the absurdity of the price matches the stability of the asset. So, as the headlines get darker and the tickers turn redder, ask yourself one question. Are you watching a tragedy, or are you watching the greatest wealth transfer of your lifetime? The answer depends entirely on which side of the panic you choose to stand on. But then again, everyone thinks they have nerves of steel until the lights go out. Would you like me to refine the pacing of the transition between the apartment building analogy and the mathematical breakdown?